We have a new president-elect, and that means changes to our tax code. In today's video, we're going to talk about those changes, which of them are going to benefit you and which of them are not going to benefit you so much because they might lead to additional inflation. And throughout this video, I'll present different solutions and strategies that you can implement so you can keep more money in-house. Now, today's video is going to be divided into 3 different categories. We're going to talk about personal individual taxes, state taxes, and also business taxes, because as real estate investors, we are business owners as well. So let's jump right into Trump's proposed tax policies and what can you and your business expect. So this is an article courtesy of Cherry Baker. Let's check out the summary and then eventually let's move into the details. So these are the key provisions. 1, extending and or making permanent many of the temporary provisions of President-elect Trump's 2017 Tax Cuts and Jobs Act, currently set to expire at the end of 2025. So that means that ever since this was implemented in 2017, we have been enjoying some of the benefits, and some of these might end at the end of 2025 unless President-elect Trump gets the ball rolling and get these approved before they expire. The following provision is cutting the corporate income tax rate from 21% to 20% and reducing it as low as 15% for corporations that make their products in the U.S. Next, imposing a universal 20% tariff on all imported goods to the U.S. and increasing that rate to 60% for imported goods from China. This provision right here has created a bit of controversy, and we're going to get to it in a minute. Next provision is to repeal selected clean energy provisions enacted as part of the Inflation Reduction Act of 2022, specifically the electric vehicle credit. So in terms of individual taxes, what does it mean for you? Well, President-elect Trump wants to make a permanent extension on individual tax cuts. So in terms of rates and brackets, the lower individual tax rates and adjusted tax bracket introduced under the Tax Cuts and Jobs Act will be made permanent beyond their 2025 expiration. This will continue to reduce the overall tax burden for many taxpayers, with the largest percentage change in after-tax income particularly benefiting middle and upper income households. So what does it mean for you in terms of numbers? So let's take a look at this table just to give you some context. So the table that you see here, these are 2024 taxes, right? So here's the breakdown of the tax rate according to the amount of money that you make, regardless of whether you're single, married, filing jointly, or filing separate, or as a head of household. And you will notice that the amount in 2024 are lower, right? So for example, under the 10% tax rate, we're talking about a max of $11,600. And then under the 12% category, you're looking at a maximum of $47,150. When you look at the 2025 number, you will see that these numbers are actually adjusted for inflation, and you can actually make more money, quote unquote, and still be able to pay the same lower tax bracket. So in other words, in 2025, you can aim to make more money while still paying a lower tax bracket. So those are the numbers right there according to your tax bracket for 2025. And hold that thought right there because we're going to come back right to this table. But I want to keep going through the different tax provisions. So the next point that they want to make permanent is the standard deduction and personal exemption. So the Tax Cuts Jobs Act nearly doubled the standard deduction while eliminating personal exemptions. Making these changes permanent will simplify filing for many taxpayers and maintain the higher deduction levels. So to give you additional context, this is the standard deduction that we will be getting in 2025. So if you're filing as a single person, that deduction will be $15,000. If you're filing as married, filing jointly, that will be $30,000. And as a head of household, you will be getting a standard deduction of $22,500. Now, how does this all come together, right? So keep this table in mind as well. And let's come back to this table right here. Let's suppose that you are currently making $55,000, right? So when you make $55,000, that means you're going to be at this bracket, at the 22% bracket. That means that if you were to file your income taxes without any deductions, your $55,000 will be taxed as the following. So the first $11,925, you're going to be paying the 10%. Then the amount that comes after that, that means $11,926 to $48,000. $475 will pay taxes at a bracket of 12%. And then the difference from $48,476 to $55,000, which is your current salary, will be paid at a tax bracket of 22%. But when you include the tax deduction in place, your numbers will look like this. $55,000 minus $15,000, assuming you're filing your taxes as a single person, that will leave you with a net of $40,000. So that automatically places you at a lower tax bracket. These standard deductions are applied for everybody. That's why they're called standard. The minute you file your taxes, the deduction is going to take place. But how do you take additional deductions before the standard deductions? So that's where investing comes into place. So for example, if you were to invest in real estate has something that it's called depreciation. So when you buy a house, that value of that house is depreciating over the course of 27 and a half years. So let's say that on an annual basis, you can take a deduction of $7,000. So if we go back to our prior example, those $40,000 will continue to go down to a lower amount. So you minus the $7,000 that you got from your real estate deduction, and now you're left with $33,000. So the goal here is to understand the deductions that you can get legally. Call it the standard deduction or any deductions from your real estate investment or any deduction that you can possibly get. So make sure you talk to your accountant so you can strategize correctly and prepare beforehand so you know what to do in 2025. And the goal here is to reduce your taxable income and get to as low as possible of a number so you can keep more money in house. Yes, it will look low on paper, but that doesn't mean you have to make less money in order to pay less taxes. Welcome to Nova Rights, your channel for financial education. In here, we cover everything related to real estate investment, precious metals, the stock market, and business investments. Another proposal here is to increment the child tax credit, which is currently sitting at $2,000 per child. So in this case, the child tax credit under the Tax Cut Jump Act will increase to $5,000 and introduce a credit for other dependents, which will continue to provide tax relief for families if made permanent. Now, in terms of itemized deduction, the Tax Cuts Jump Act removed several itemized deduction and eliminated the PEAS limitation, which reduced the value of itemized deduction for high-income taxpayers. Included in this was the much publicized $10,000 limitation on state and local tax SALT payments. Some of the impact of these taxpayer-unfriendly positions will be offset by the increased standard deduction. Now, just to give a little bit of context, prior to the Tax Cut Jump Act, the itemized deduction, let's say, was kind of like the preferred way to take your deduction. So back in the days, the itemized deduction had a much higher limit. So people will come in with their receipts and their bills that are applicable for a deduction, and they will try to get in as many deductions as possible so that they will deduct those expenses and reduce their taxable income to the highest amount as possible. But under the Tax Cut Jump Act, the maximum amount of itemized deduction was set at $10,000. So it didn't make any sense for you to go through all that extra trouble of saving receipts and invoices and anything like that when you can just take the standard deduction, which was offering you a much higher limit. And from what we see here, this is not going to change. It's going to remain as it is because it is more beneficial to you as an individual taxpayer to take the standard deduction. Another interesting proposal, and this one has created a bit of controversy, is the proposal of having tips, overtime pay, and Social Security tax-free. It's kind of interesting. We'll see how that goes. A lot of experts are saying that this will probably not make it pass, but it's interesting to see how everything unfolds. Only time will tell. Now, let's talk about state taxes, right? This applies to everybody regardless of your state. Don't think that because you haven't built anything yet or because you have a small portfolio that this will not impact you. It is always good to have this information readily available so you can do the right state planning and have that informed conversation with your accountant. So according to this, the Tax Cut Jump Act doubled the state tax exemption, allowing individuals to pass on larger states tax-free. If these provisions are made permanent, it will mean that more individuals could transfer wealth to heirs without incurring state taxes, effectively reducing the tax burden on large states. Now, let's put this into context, right? Because it sounds like it's a lot of words and no meaning to it. So let's take a look at this article from Smart Assets, right? And let's start by talking about annual gift tax deduction. So the IRS allows individuals to give away a specific amount of assets or property each year tax-free. In 2025, the annual gift tax exclusion is $19,000, meaning a person can give up to $19,000 to as many people as he or she wants without having to pay any taxes on the gifts. For example, a man can give $19,000 to each of his 10 grandchildren in 2025 with no gift tax implication. For context, the 2024 gift tax exclusion is $18,000. So we're talking about an increase of $1,000. So this is particularly helpful for those who want to give cash as a gift. So let's say, for example, you're a parent and your child is all grown up and is looking to buy a home and you want to help out with the down payment and you want to make a gift. So you can make up to $19,000 as a cash gift to help your child with the down payment of their home tax-free. That's just one example. Now, continuing with the same example in the article, let's say that perhaps the same man chooses to give each grandchild $22,000 instead, exceeding the 2025 exclusion limit by $3,000 per gift. How did I get to that number? Very easy. You take $22,000 minus $19,000, which is the limit for 2025, and that will give you a difference of $3,000, right? So in this scenario, Grandpa could potentially owe gift taxes on the $30,000 average, but not necessarily. How did I get to $30,000? Well, the article mentioned 10 grandchildren. So $3,000 per gift multiplied by 10, that's $30,000. Now, how does this apply to married couple? Well, each spouse may give away $19,000 tax-free in 2025. So let's say, for example, Cynthia and Joe, right? A married couple, they are allowed to give up to $38,000 to each of their 3 nieces and nephews every year. Now, this is the part where all this gift tax becomes very interesting, right? There's something called a lifetime IRS gift tax exemption. So the way the IRS looks at this is that they look at the gift that you have given throughout your entire lifetime, not just that 1 year. They do look at the year, but they also look at the overall, right? So let's say, for example, if a gift exceeds the $19,000 limit for 2025, that doesn't automatically trigger the gift tax. Also, for 2025, the IRS allows a person to give away up to $13.99 million in assets or property over the course of their lifetime and as of part of their estate. If a gift exceeds the annual exclusion limit, the difference is simply subtracted from the person's lifetime exemption limit and no taxes are owed. So let's consider this example for 2025. Susan decides to buy her granddaughter a $30,000 car as a college graduation present. Susan's gift will technically exceed the 2025 exclusion limit of $19,000 by a total of $11,000, but she wouldn't owe additional taxes. That's because she will report the gift to the IRS using a Form 709 and deduct $11,000 from her $13.99 million lifetime exemption. And as a result, she will still be eligible to give away up to $13,979,000 tax-free. Now, let's do a breakdown and a table because it's easier for the visuals, right? So you have a gift value. So this time we're talking about a $30,000 gift. That was the car. And that exceeded the 2025 gift tax exemption of $19,000. So the taxable amount of that is $11,000. You take $30,000 minus $19,000, you get $11,000. So that taxable amount of $11,000 will be subtracted from that $13,990,000. And the remaining lifetime exemption for this person will be $13,979,000. That's why it's really important to pay attention to this because no matter how small the amount, everything will start to add up. That's why the Trump administration is proposing to make the Tax Cuts Judged Back provision permanent because that's a very nice, sizable amount. But if it doesn't get approved, the lifetime gift tax exemption will revert back to $5 million. So that's a big difference that we're talking about. $13.99 million versus $5 million. You do the math, right? Now, I want to know your opinion. Do you think this $13.99 million tax exemption, it's a lot? Or do you think that $5 million, it's more than enough for you? Let me know down in the comments and why do you think that's enough? Now, it's time to talk about business tax provision. The proposal aims at a 100% bonus depreciation. That is the ability to immediately deduct the full cost of eligible capital investments, and that will be restored, encouraging businesses to invest in new equipment and infrastructure by reducing their taxable income. In addition to that, there is the category of R&D expenses. So the Tax Cuts and Jobs Act require research and development costs to be capitalized and amortized over 5 years. However, eliminating this treatment to allow business to deduct R&D expenses immediately will reduce compliance burdens and promote innovation. Another provision, interest deduction limitation. So the Tax Cuts and Jobs Act initially allowed businesses to calculate interest deductions using EBITDA, that is earnings before interest, taxes, depreciation, and amortization, which was later restricted. Reverting to the EBITDA calculation will expand the amount of interest expense that businesses could deduct, benefiting highly leveraged companies. Now, let's transition to tax cuts for corporations, particularly manufacturers. First, we have the reduction of corporate tax rate. President-elect Trump has proposed further reducing the federal corporate tax rate from the current 21% to 20%. This reduction aims to make U.S. businesses more competitive internationally and encourage economic growth. I'm guessing that the goal here is to make services or their products cheaper so that products or services made in the U.S. have a competitive advantage against those services or products that are imported from other countries. Next, lower rate for domestic manufacturers. For companies that manufacture products within the U.S., President-elect Trump has suggested lowering the tax rate even further to 15%. This policy is intended to incentivize domestic production and potentially bring manufacturing jobs back to the U.S. Now, let's talk about tariffs, right? That's the point that has created the most controversy so far since Trump got elected. So there's the proposal of a universal tariffs policy on foreign imports. And the proposal is looking at 60% on Chinese imports and 20% on imports from other countries. And this aims to protect U.S. manufacturing by increasing demand for domestically produced goods. Still, it might result in significant price hikes for foreign goods. Now, again, this proposal has created a lot of controversy because experts are saying that this could lead to additional inflation. Let's just face it. When we buy a product as consumer, as far as I know, we tend to buy a product based on its functionality, based on the value, on the cost. We don't buy a product based on where they're made. At least I don't do that. And the people that I know, they don't do that, right? So the whole thing about tariffs is that, well, tariffs already exist, right? So anything that gets imported in the U.S. is already paying a tariff. And we pay for the cost of that through our purchase. So what this proposal is suggesting is that anything that's coming from China now is going to pay a higher tariff at 60%, and anything that's imported from another country, it's going to be taxed at a 20% tariff. Now, I can see why Trump thinks this is a good thing because it might deter people from buying imported goods and they might want to buy goods that are produced in the U.S. But again, that doesn't apply across the board. Maybe some products will get a more competitive advantage, but not all of it because it will all depend on the functionality and the value for money. And what experts are saying is that this is going to create more inflation because let's say, for example, if the consumer were to go to the import still, regardless of the incentives in the U.S., that means that that import will eventually be more expensive because there's a higher tariff, right? And who's going to end up paying that higher price? Us as the consumer. And that will eventually lead to more inflation. That's just the cycle that everyone is worried about. But again, this is just a proposal. Only time will tell. Next, let's talk about clean energy tax credit. The upcoming changes to the political landscape have raised some important questions about the continuing evolution of the U.S. energy policy. While it is unlikely, the most recent source of key climate incentive, that is the Inflation Reduction Act, will be completely repealed. As the country enters territory with sustainable energy growth policies, it is important to remember a few key points. Federal tax credit for wind and solar were not introduced under the IRA. These clean energy incentives had been in place for decades. The majority of the IRA budget was allocated to red states, with 80% of funding directed to these and other battleground states in the recent election. Additionally, IRA funding has significantly contributed to domestic job creation and reshoring of U.S. manufacturing over the past 2 years. While the path for clean energy might have shifted, these are reasons to believe that the key aspects of the IRA, including its transferability mechanism, will continue. So in other words, the proposal it is to have the IRA repeal, but it is unlikely that it will happen. But again, only time will tell. So hope the content is proven helpful in helping you plan for the upcoming years so that you can reduce your taxable income as early as possible and not go crazy at the last minute. I'll see you in the next video. Take care. Bye-bye.